Welcome back to the Deep Dive, where we take your pile of information and unearth the most fascinating insights. Today, we're diving into a world that's buzzing with innovation, confusion, and honestly, massive potential digital assets. This deep dive is all about pulling back the curtain on what digital assets truly are, how their value operates, differently from traditional assets, and how they function within these groundbreaking new digital economies. To guide us, we've pulled from a stack of incredible sources, in-depth reports from financial advisors like Houlihan Lokey, some rigorous academic research on tokenomics and market dynamics, and even a white paper from an immersive metaverse gaming platform.
Yeah, and what's truly fascinating here, I think, is that we're moving beyond just cryptocurrencies. We're looking at the broader landscape of digital assets and how they are fundamentally changing the way value is created, owned, and exchanged. Our mission today is really to equip you with the essential knowledge to navigate this rapidly evolving space, understand its real-world applications, and maybe even spark some aha moments about how this new Internet of Value truly works.
Okay, let's unpack this then. We're talking about the Internet of Value, where economic assets can be transferred as easily as information. So what are these digital assets fundamentally?
Right, so at its core, digital assets are basically representations of value that live on a blockchain.
Hmm?
And like you said, it isn't just about Bitcoin anymore. It's a really wide spectrum. It includes everything from cryptocurrencies like Ether to NFTs, non-fundable tokens, which represent unique items or verifiable ownership, and other tokens that might provide utility within a digital ecosystem or maybe signify a stake in a project.
That sounds like a pretty fundamental shift from the traditional online world, the Web 2 world we've kind of grown up with. Can you elaborate on why decentralization and these peer-to-peer interactions are so powerful compared to that older model? What's the practical impact?
Oh, it's a seismic shift, really. Think about Web 2, right? Data ownership was often centralized. You were mostly reading and interacting on platforms owned by big companies. Web 3, this Internet of Value, is all about shifting to decentralized peer-to-peer interactions. And this enables something profoundly powerful: actual community ownership and genuinely transparent digital ecosystems. A key advantage here, and this is important, is fractionalization. Unlike, say, a physical painting or even a share of a traditional company, many digital assets can be split into tiny, tiny transferable units.
Okay, so you can own just a small piece of something valuable.
Exactly. And that dramatically increases liquidity and allows for much wider participation in these novel tokenized economies. It sort of democratizes access to assets in ways previously unimaginable. It really starts to deliver on that promise of ownership that isn't gated by, the traditional institutions.
That clarifies it. So if these digital assets represent value and they can be owned and traded in these new ways, how do we even begin to understand their underlying economy? I think that brings us to tokenomics.
Tokenomics, yeah. It's essentially the economic blueprint of these digital ecosystems. It's about how tokens are created, distributed, managed, and used. And it's all governed by the classic principles of supply and demand, but with a unique digital twist.
It sounds like there's a lot more to it than just a basic supply and demand chart, though. What are some of those unique complexities?
Oh, definitely. Tokenomics is a multifaceted discipline. It demands expertise from fields like, well, human behavior, rigorous economic modeling, and strategic design. It covers everything from the incentive mechanisms that encourage specific actions, like rewarding users for providing liquidity or participating in governance, to understanding diverse market demands, whether it's for asset-backed tokens, crypto-backed tokens, or stablecoins. It also involves setting up robust governance structures, often through what are called Decentralized Autonomous Organizations, or DAOs.
DAOs, right, giving communities the power.
Precisely. They essentially give communities collective power over a project's direction. The core takeaway here is that tokenomics isn't just a technical blueprint. It's almost the behavioral psychology of a digital economy. A well-structured value system drives greater demand and, crucially, helps counter that boom collapse effect we've unfortunately seen in many token issuances.
Yeah, and here's where it gets really interesting, or maybe concerning for many people. We've seen some major collapses in the crypto market, like FTX and Terra. What do those examples tell us about the importance of getting this tokenomics stuff right?
They're stark reminders, aren't they? They show what happens when tokenomics are poorly designed or when the project models are just fundamentally misaligned. With FTX, the downfall was caused by unsustainable token models, massive over-leveraging, and incentive structures that basically pushed risky, speculative behaviors. The FTT token itself was artificially inflated, creating this false sense of success. When it collapsed, the lack of real underlying value became painfully obvious, although it's often framed as a failure of centralized, irresponsible power rather than, an inherent flaw in crypto itself.
Interesting distinction. So if FTX was more about that centralized failure, what was the core flaw with Terra? Was it similar or something else?
Terra was a bit different. It failed mainly due to a fundamentally flawed stablecoin model and, again, weak governance. Its algorithmic stablecoin, UST, relied on a sister token, LUNA, to maintain its peg to the dollar. When market conditions got volatile, the mechanisms designed to keep it stable just failed. It led to a death spiral.
A death spiral. Wow.
Yeah, where both LUNA and UST tokens, which had ballooned to a combined market cap over $50 billion, just collapsed. In Terra's case, short-term decisions like inflating the supply rapidly to try and maintain the peg without sufficient reserves ultimately destabilized the entire system. Both cases really illustrate a devastating domino effect. They reinforce that even in this decentralized internet of value, careful, transparent design is absolutely paramount to prevent these kinds of systemic collapses and protect users.
This raises a really important question then. If the design is so crucial, how do we even begin to value these digital assets, especially when they seem so different from what we're used to in traditional finance?
That's a huge challenge, and it's one that financial institutions are actively grappling with right now. Alternative asset managers are indeed increasingly looking to invest in digital assets, often beyond just the big cryptocurrencies. However, headwinds like the 2022 crypto crash, plus exchange bankruptcies and just ongoing regulatory uncertainty have definitely caused many to delay or hesitate their full embrace.
But the fundamental belief driving this interest remains strong, doesn't it? What's the core investment thesis here?
Exactly. The core thesis is that this disruptive blockchain technology will create viable and useful real-world solutions that can operate without necessarily needing traditional centralized institutions. Think about it. Traditional payment systems like ACH or Visa, they're centralized. They have their own walls, their own overheads, owned and controlled by the beneficiaries, right? But they operate as distinct companies. In contrast, a blockchain-based system like Ripple aims to provide a decentralized payment solution, effectively removing those intermediaries and offering a peer-to-peer alternative.
Okay. And when valuation agents look at these digital assets, what categories do they typically focus on for valuation? Are they valuing everything?
Well, not exactly. Nearly two-thirds of the digital asset market by value actually consists of currencies or stablecoins. Those aren't typically valued by third-party agents in the same way. But the remaining third, roughly 33%, primarily smart contract platforms like Ethereum, and then DeFi, decentralized finance, computing, and entertainment tokens. That's where valuation agents concentrate their efforts. For these, a discounted cash flow, or DCF method, can actually be quite effective. It's based on projected revenues for the protocol itself, kind of similar to how you'd value a traditional business.
Can you give us an example? How would this DCF method work for a major digital asset, say Ethereum?
Yeah, Ethereum ETH is a powerful example. It recently earned an aggregate of $10 billion in revenue in just 7.5 years.
Wow, 7.5 years.
Yeah, and to put that in perspective, giants like Microsoft and Adobe each took about 20 years to earn a similar amount earlier in their histories. So with Ethereum's current market cap around $200 billion and about $2.6 billion in annual revenues, this implies a revenue multiple of roughly 77x. Now, that's a valuation comparable to some highly successful unicorn startups and other, transformative assets. It demonstrates a significant perceived value in its underlying utility and growth potential.
But what happens when the valuation isn't so clear-cut? I'm thinking about that Ripple example from our sources. It really highlights the complexity and, well, the disagreements.
Oh, the Ripple scenario is truly fascinating.
Yeah.
It perfectly showcases the wide disparity in perceived value and how valuation can become this sort of battle of perspectives. So Ripple itself reportedly has about $1 billion in cash or securities and holds a massive 46 billion XRP tokens. But if you look at different public sources and secondary private markets for its equity, the implied company value just goes wild.
Yeah.
It ranges from $4.5 billion to $11.3 billion, all the way up to $28.6 billion.
Huge range. And how does that affect the token itself, the XRP?
Well, that's the crux of it. That massive range in company value leads to implied XRP token prices ranging from as low as like 7.5 cents, 0.06, up to 60 cents. And this was at a time when the actual market price was already as low as 60 cents per token.
So some valuations imply an 84% discount.
Exactly. an 84% discount in some valuations. It's not just a statistical anomaly. It highlights the sort of Wild West nature of digital asset valuation right now. You have investors and accountants wrestling with whether to value an enterprise based on its traditional balance sheet or on the, let's say, speculative potential of its associated token. The key insight is, in this space, valuation is less about finding a single perfect formula and more about a battle of fundamental perspectives and future potential. It's really quite something. And what's particularly relevant here, and timely, is that new accounting guidance from FASB, that's ASU 2023-8 from December 2023, is set to change how companies report crypto assets. They'll now have to report them at share value, even if there isn't an active market for them.
Okay, fair value. How does that impact our Ripple example?
Well, for Ripple, this guidance could potentially cause financial statements, maybe for a future IPO, to reflect the actual market price of the XRP token. That could push the market estimate of the company's value much closer to that theoretical full price of $28.6 billion we mentioned. So this accounting change has real, tangible implications for how these companies are perceived, how they get investment, and even how they might eventually go public. It's a big deal.
So valuations are complex, evolving. What does all this mean for how these digital assets actually move and impact the market, especially when we talk about their utility? Let's shift gears and talk about token velocity.
Right, token velocity, it's a really crucial metric. It basically refers to how frequently a token changes hands within a specific period. It's often understood through the equations of exchange, MV equal PQ.
Okay, break that down for us. MVPQ.
Sure. M is the money supply, the total amount of the token. V is the velocity, how fast it changes hands. P is the price level of goods or services bought with the token. And Q is the quantity of those goods or services. This framework helps us understand how changes in velocity directly impact token value. In simple terms, if a token changes hands more frequently if V goes up, then either its individual price, P, might need to decrease, or the total volume of goods and services it facilitates, Q, must increase to keep the overall economic system balanced. It's really about how much work each individual token is doing within its ecosystem.
Can you give us a practical, maybe a real-world example of how that velocity plays out?
Absolutely. Our sources mention a digital coupon token example, like the one Starbucks used on the AI network. If customers delay redeeming their coupons by an average of, say, 10 days, the circulating supply of that token could effectively become 10 times the daily revenue generated by redemptions. This dramatically affects the token's market dynamics and value just based on user behavior. It really shows velocity's real-world impact.
So what are the practical implications then? Is high velocity always good?
Not necessarily. High velocity often signals active market participation, which can be good, but it might also suggest there aren't enough incentives for people to actually hold the token long-term. Conversely, low velocity could imply strong holder confidence, maybe long-term investment belief, but it might also point to limited immediate utility or use cases. The optimal velocity really varies. It depends heavily on the token's specific purpose and the overall design of its ecosystem. It's not always about being fast, but about being right for its function.
Okay, that makes sense. Now, beyond just how fast tokens move, there's another fascinating market dynamic mentioned, the lead lag effect. How does that operate in these digital spaces?
Yes, the lead lag effect. It's a phenomenon where one security's price movement tends to, well, precede another's with some delay. Interestingly, the sources note that social media generally weakens these effects and accelerates adoption for new products just by spreading information faster. Makes sense, right?
Yeah, information travels instantly now.
Exactly. But in the context of Metaverse tokens, research shows that trading volume is actually a strong predictor of these lead lag patterns.
Okay, so volume matters. How does that play out practically for traders or investors in the metaverse?
Well, high-volume tokens tend to lead low-volume tokens. They respond faster to market-wide information. This supports what's called the speed of adjustment hypothesis, which basically suggests that information diffusion isn't instantaneous, even in these modern digital markets. There's still a delay. So for you, the learner, this is a practical insight. It implies that traders could potentially strategically adjust positions in follower tokens based on the market movement of the leading higher volume tokens. It's about understanding how information flows and impacts pricing, even in these cutting-edge digital spaces. It's not just about what the token is, but how it moves in relation to others.
This is great context. Now, to really bring all these concepts, tokenomics, valuation, velocity, lead lag to life, let's look at that concrete example from the sources. Star Atlas. It sounds like a gaming metaverse that embodies so many of these ideas, almost like a real-time economic laboratory.
Star Atlas is a fantastic example, yeah. It's a virtual gaming metaverse set way out in the year 2620. You have three major factions: humankind, various alien races, and sentient androids battling for resources, territory, and political domination across a vast galaxy. It's a truly unique blend. It combines traditional core gaming elements that players love with really advanced blockchain mechanics, offering players this persistent, evolving universe.
And it uses a dual token system, which
Okay.
ties right back into our discussion of tokenomics. Why have two distinct tokens? What's the purpose there?
It's exactly, good pickup. It uses two primary tokens, each with a very specific role: Atlas and Polis. Atlas is essentially the in-game currency. Think of it as the lubricant of the metaverse. Players use Atlas to acquire digital assets, ships, crew members, land plots, and also to cover operating expenses like fuel for their ships, repairs, things like that. And crucially, the development team retains zero stake in the undistributed Atlas supply, really emphasizing a player-driven economy from the start.
Okay, so Atlas is the day-to-day currency. What about Polis?
Polis is the multifunctional governance token. It has power both in-game for strategic decisions within factions and alliances, and also for real-world economic policy decisions within the game's universe. For example, players can use Polis to influence things like imposing taxes in player-owned cities, which are called Decentralized Autonomous Corporations, or DACs. Players can earn Polis by staking their Atlas, but this is a fascinating trade-off. Staked Atlas cannot be used for active gameplay, so it creates this strategic choice for players. Do I invest for governance power, or do I keep my capital liquid for playing the game?
That's interesting. And it's not just virtual items. Players gain true asset ownership through NFTs, right?
Okay.
How does that change the game, literally?
Precisely. This is a core difference from traditional games. Unlike games where the company owns everything, in Star Atlas, players have complete control of their purchased assets, their ships, their land, their equipment. Why? Because they exist as NFTs on the blockchain. This means their in-game earnings, the assets they acquire through gameplay, can potentially be converted into real-world income. It fundamentally changes the monetization of time spent gaming.
So your time playing can actually generate real-world value.
Potentially, yes. It's a genuine shift from just playing for a company to actually owning what you build and earn within that virtual world.
And the technology behind it sounds pretty robust to enable this complex economy.
It is. It's built on the Solana blockchain, which is known for its speed. Star Atlas can handle, reportedly, around 50,000 transactions per second. This allows for a largely serverless multiplayer experience with real-time smart contract execution of game scenarios, things happening on-chain instantly. That's pretty advanced stuff.
Yeah.
What's more, it has direct DeFi integration.
DeFi. Decentralized finance, right? In a game.
Yeah, directly integrated via Serum DEX, which is a decentralized exchange built on Solana. This means players can participate in activities like loaning out their in-game assets for interest, acting as automated market makers by contributing assets to trading pools to earn fees, or even yield farming, earning rewards by staking or lending assets, all right there within the game interface. It's this really fascinating blend of high-end entertainment and complex decentralized finance all on one platform. It makes these concepts accessible, maybe even fun.
You mentioned earlier how crucial good tokenomics are, especially managing supply and demand. How does Star Atlas specifically address that? Does it have ways to create scarcity or control inflation?
That's a great question, and yes, it does. They've built in several deflationary mechanics. For instance, if your ship gets destroyed in combat, it's permanently destroyed. The NFT is actually burned and removed from circulation.
Ouch. Real consequences.
Definitely real consequences. Also, certain farmed materials in the game are non-permanent. They get consumed through use. Additionally, the development team has committed to a token repurchase and burn program using a portion of the game's revenues. This creates a sort of natural, ongoing deflation of assets over time. These mechanisms are really key to trying to ensure long-term value and preventing an oversupply that could potentially devalue the in-game economy.
And the grand vision for Star Atlas sounds like it extends even further, beyond just the current gameplay loop.
It absolutely does. The long-term vision is really ambitious. It includes enabling player-created content, thinking designing assets, ship skins, maybe even efficiency algorithms that could be sold on the marketplace. There's also the future ability plan for players to explore completely new regions of space, maybe even store assets on different blockchains eventually, all within this unified game experience. They even mentioned, kind of aspirationally, turning player processing power towards real-world exploration tasks like, get this, searching for UFOs, blurring the lines between virtual play and actual scientific contribution.
Wow, okay. So what does this all mean for you, the listener? Star Atlas really serves as an active, living example. It shows how all these concepts we've discussed, digital assets as NFTs, careful tokenomics with 8 to lands, and Polis, the underlying blockchain tech, velocity of assets, maybe even lead-like effects between different asset types in the game, how they all converge.
Exactly. They converge to create entirely new economic models and player experiences. It showcases the real world, or maybe virtual world, applications of these complex ideas, demonstrating how these digital economies can actually be built and hopefully thrive.
What a deep dive indeed. We've journeyed from the fundamental definitions of digital assets all the way to the intricacies of tokenomics. We explored how their value is assessed, which is clearly still evolving, and seen how market dynamics like velocity and lead lag effects play out, especially in cutting-edge platforms like Star Atlas.
Indeed. And I think we've highlighted that digital assets offer these unprecedented opportunities for community ownership and, transparent economic activity. But crucially, they also underscore the critical importance of robust token design and governance to avoid the pitfalls we saw in those past collapses. Understanding these unique valuation methods and market behaviors is really essential for anyone engaging with this new Internet of Value and its growing real-world implications, whether you're building, investing, or just, well, playing a game like Star Atlas.
Absolutely. So for you, whether you're prepping for a meeting, exploring a new field, or just find this stuff insanely curious, we hope this deep dive has given you a shortcut to being well-informed. The world of digital assets is complex, no doubt, but the underlying principles that drive their applications and effects are becoming clear, offering real utility and some fascinating new economic models.
And this maybe raises an important question for you to consider as we wrap up. As digital assets increasingly permeate our real-world economy, how might these principles we've talked about, tokenomics, velocity, lead lag, how might they apply to non-digital assets or traditional markets in the future? What new insights might we gain by looking at established systems through this new, maybe slightly strange, digital lens? Could we find inefficiencies or perhaps new opportunities where we least expect them?
Definitely food for thought. Thanks so much for joining us on this deep dive. Until next time, keep exploring, keep questioning, and keep getting informed. We appreciate you being here.